So let me start by saying, well, I don't know if Happy New Year is the right phrase here. It is a new year. Whether you will be happy, it's another question. I met David as he mentioned last year in Venice, where I uh, had the chance to hang out with a previous cohort of your masters, and I was very impressed by the quality of the dissertations that they produced, and very happy to engage generally in other conversations. And I thought, why not come back and try maybe to persuade some of you to write your dissertations or to think about a field of work that I've been developing with several other colleagues called critical macrofinance. And I'll tell you in a second what I mean by this. And I thought maybe to illustrate the usefulness of this analytical framework, I would present and talk you through a report that I have written very recently, commissioned by the Committee on Economic and Monetary Affairs on transatlantic fault lines. That is, they said, can you think about the risks and opportunities in EU-US economic relationships? And as you will notice in the next 45 minutes, it didn't occur to me to include the invasion of Greenland as one potential fault line. We'll see how that develops. In this report, instead, I ask several questions about how can we think about the relationship between the EU, broadly understood, and the United States over the short and medium run, right? And you will see by definition, this is although this is a very big question, I focused on several areas where I thought there is something interesting to say from a critical macrofinance perspective. And I'm very interested to hear what you think about it. I will, of course, try to develop this further once some of the sort of ideas and dynamics that I notice in this paper, once they evolve one way or another. And the starting point in many ways for this paper and for the work that I've been doing more broadly is to say that we live in a very different world now than 5 or 10 or 15 years ago. Not because globalization has ended. I think it's complicated. It's a complicated story. But we definitely don't have globalization as a kind of ideological horizon for, at least for liberal political parties anymore, or for parties in government. And the better way to characterize the global economy now would be a competition between transformative state projects, in the sense that what we thought about as the neoliberal state, what we thought about the hegemony of neoliberalism as a set of political and economic ideas that privileged the free movement of capital, that constructed the state or demanded of the state that it secures property rights, that it creates and secures macroeconomic stability, broadly understood as price stability, that it reduces interventions in the cross-border flow of both trades, of both goods and services, and of capital. That kind of paradigm of neoliberalism and that kind of paradigm of state action, to me, it's done, it's finished. We are done with it. We are moving now towards a state that has overt transformative ambitions. It is the state is willing to use statecraft to weaponize economic tools for national transformative ambitions. And this weaponization can go from the Biden administration's Inflation Reduction Act, which, if you remember, 4 years ago, it produced a lot of outrage in European capitals, not as much as we see today, but there was significant outrage towards what many, at least in Brussels and in Frankfurt, described as a break with the international liberal order. now, for at least in the US, this transformative state project is taking a new form under the Trump administration, both with the tariff policy, and I would call these, at least in terms of their ambition, they are transformative tariffs. They are thought and designed in some ways to change the economic structure of the United States. You will see also with an AI policy and an AI strategy that, to me, again, has transformative ambitions behind. And in parallel to this, there is, at least when we think about the global economic competition, there is the I would call it the stunning success of the Made in China 2025 industrial policy strategy launched by China in 2015. And to me, in many ways, and maybe we can discuss this later if you're interested and you want to me, in many ways, 2015 and China's launch of this industrial strategy is what precipitates or accelerates the shift away from a paradigm of globalization towards a paradigm of geopolitical conflict and competition between transformative states. And the European Union is a complicated actor in there because, and I will come in a second, because it lacks certain, at least political mechanisms which would allow it to articulate and pursue a transformative vision in the same way that China can, or in the same way that the United States, both under the Biden administration and under the Trump administration, can. And just to give you, so in the report, as I understand from David that he has circulated the report. If you haven't read it, I hope you will. It's a report written as a policy document rather than let's call it a scholarly paper. So it sort of does take a few jumps here and there, but if you want to understand the theoretical framework behind some of the arguments in the report, it comes from critical macrofinance. And just to very quickly summarize what is critical macrofinance, it used to be very cool a few years ago when we still had our eyes on the financial system and on big finance as important political actors. And critical macrofinance comes from the tradition of Hyman Minsky and post-Keynesian more broadly, who at least since 1957, you can go back, but I like to cite this article by Hyman Minsky, 1957, who said, look, we have to be interested in the co-evolution of financial structure and the macroeconomic policy-making institutions of the state. In other words, when finance changes, the institutions of economic policy change as well, and this change is dynamic. There is a kind of institutional codependency and co-creation that is occurring there. And I won't develop it very at length here. I can take questions. And the macrofinance in critical macrofinance comes from or draws on Keynes and Minsky as theorists of capitalist finance. And I've given you a couple of readings there where you can see that elaborated. And on top of this interest in the coevolution of financial structure and the economic policy making, there is a specific attention paid to political economy, to questions of politics, to questions of how does a particular policy instrument or a particular strategy, how does it get chosen? Why does it get chosen? Why does the ECB decide to do the transmission protection instrument in 2021, but it doesn't do it in 2008? I heard you had Jean-Claude Trichet there. I'm curious what you thought of him. To me, he was a very interesting central banker, one of the most disastrous central bankers that the ECB has had. And I can elaborate on why I think that's the case. If he's there, apologies. I am strictly speaking from the point of view of critical macrofinance. Anyway, so to understand why I would say this about Trichet, we have to think about the political economy of the kinds of economic policy interventions that are possible or not given specific political constraints. And there are 4 pillars here, and these 4 pillars matter for us to understand what is the starting point for some of the dynamics that we're witnessing at the moment. First, that for the last 40 years, what we tend to hear described as a period of neoliberalization or of global capital, rampaging freely everywhere, including in China. from a critical macrofinance perspective, it's a period of US-led financial globalization. In other words, we have, starting from the US, also in the European Union and in other rich countries in the global north, and then moving towards countries in the global south, we have a structural shift towards market-based finance, towards credit created through capital markets, through bonds, for example, through equity, financed in, excuse me, credit created, in securities markets and finance through collateral-based wholesale money markets and derivative markets. And this creates what I described elsewhere, a portfolio glut. In other words, we are seeing a growing glut of institutional capital. And when I think of institutional capital, I think about pension fund capital, I think about insurance companies, I think about sovereign wealth funds that are moving or accumulating significant chunks of capital that is managed by either sort of mainstream asset managers like BlackRock or alternative asset managers like private equity. And there is also political dynamic in there, because these asset managers, as they try to find asset classes, or by asset classes I mean financial instruments that generate some kind of appropriate risk return profile, as they try to find new asset classes, for example, in nature or in education or in housing. They are pushing the countries where they are that they are entering, they're pushing them to change the local financial system, to liberalize derivative and repo markets. So there is a political dynamic that accelerates financial globalization, because these large global asset managers, wherever they go, they want to have the possibility to enter and exit both the securities markets and money markets with the same speed that they have in the US or in Europe. And the other two important things here is credit creation looks differently, and there are new forms of money. New forms of money that are produced, and this we know from the work of Perry Mehrling and Stephanie Kelton and several others in the post-Keynesian tradition, that, one of the, Victoria Chick before them, that one of the distinguishing features of capitalism is that banks and other types of financial institutions, what we call the shadow banks now, they are constantly trying to innovate new forms of money, because the money that is guaranteed by the state is expensive, right? Bank deposits are expensive in regulatory terms for them. So they are constantly trying to innovate, to produce financial instruments that have moneyness. That is, that they promise at par convertibility, a one-to-one convertibility. And we will see this is important for stable coins. They are constantly trying to produce moneyness without the backing of the state, because it's cheaper. It's cheaper to finance financial innovation. So that's an important feature that we have to bear in mind whenever we think about the financial system, is the constant push towards new forms of money. And there is a specific argument here about what kind of transformations of the state are occurring when we are moving from bank-based finance towards market-based finance, and that the state is required to stabilize new types of money, new types of systemic liabilities, like repo liabilities and government bonds. And this is why I was a bit provocative when I described Jean-Claude Trichet as not a very good central banker in that sense, because the structural changes in the European financial system made it imperative, in this case, for the European Central Bank to intervene directly in sovereign bond markets in order to stabilize their properties as high-quality collateral. And whether you do that or not, it's not simply a question of do you want to provide financial stability or not? Is it your responsibility to provide financial stability? But it's also a question of, are you going to rescue the Greeks or the Spaniards, whom the Germans think that they are not particularly rescue-worthy. So there is a political dynamic there that comes from the changes in the nature of financial stability, broadly understood. We can come back to this. I'm not going to spend a lot of time, although it's relevant to understanding some of the current dynamics. And what I want to do in the remaining time is to say there are three broad sources of tension or sort of three fault lines when we think about the relationship between the United States and the European Union. The first one is the possibility of an AI Minsky moment. By AI, I mean artificial intelligence. Uh, and I make here an argument that although we focus a lot of attention on the impact of US tariffs on the European economies, because of the, let's say, call it the relatively random nature of the demands of the Trump administration that cannot be met, there is a bigger threat from the potential collapse of the investment bubble that is growing in the US AI sector, because it is funded, it's increasingly funded not through a firm's own cash flow, but through shadow banking or through private equity markets. So that's the first argument I'm going to make is what if there is, I mean, I don't think it's so much a question of debate anymore if there is an AI bubble, but what happens to cross-border sort of spillovers if the AI bubble in the US implodes in the near term? The second story that I tell in this report is, again, thinking about the de-risking state, is that the EU is kind of trapped in a competition between what I call soft budget constraints in the artificial intelligence sectors in the US and soft budget constraint strategies in clean tech in China. And between these two kind of industrial policy approaches, the EU has a very hard time producing a competitive response that would allow it to at least maintain, if not increase, market shares in high-tech sectors. And one of the reasons why the EU is not very, has not proven very good at competing in this transformative state project world we live in is that it cannot design an industrial policy, although it has tried. It cannot design an industrial policy that learns from previous successful experiences with industrial policy, which are you can't just bribe private capital into following your transformative ambitions, you have to discipline it. And the question of disciplining capital is very important in the story that I tell about the European failures to basically compete against both China and the US. And the third one is about the global euro ambitions. I don't know how many of you follow the debates in the European Parliament and the ECB, but Christine Lagarde, the president of the European Central Bank, has pushed for a global euro. And in parallel, the European Parliament is pushing for an alternative to American dollar or USD stablecoins, because there is a growing concern that we are losing. We in Europe, and I say this because I'm Romanian, so I consider myself European, we in Europe are under severe threat of significantly diminished monetary sovereignty. We didn't have absolute monetary sovereignty before because we live in what Helen Ray called the global dollar cycle. But the threat of euro-dollar stablecoins is significant in my mind, and we should take it seriously. So these are the three things that I want to talk to you about: shadow banking, threats in the AI sector, state capacity in designing and enforcing industrial policy in the European Union, and the prospect of global euro ambitions. That is, we will replace, I know now for some of you this might sound a bit I don't know if ironic, it's not ironic or paradoxical. When I wrote this report a month ago, the European Union still looked like it had global euro ambitions. Now it doesn't seem to have a lot of political will to stand up to the United States in very many different ways. But there is a question of, is it possible that the euro would at some point replace the US dollar? It was a more persuasive question 20 years ago. Now everything is flux. I don't know if the AI bubble implodes, maybe we will live in a different world. Right. So just to give you, the report has several it has a discussion and several graphs around what is happening to trade flows, or what has happened to trade flows since the Trump administration has assumed power. I don't think, and I'm happy to talk to you. I don't think there is a very big story there of some sort of dramatic reversal of trade flows. What is more dramatic in some ways for the short term in terms of macrofinancial threats is the unprecedented scale. Well, unprecedented scale is a bit bombastic, but it's stunning how quickly. The capital expenditure in the United States AI sectors has been. It's for comparison in 2024 and 2025 alone, there were 600 billion US dollars invested in AI capital investment, and the European Union AI Action Plan envisages 200 billion by 2030, right? So the order of magnitude is significant, and what we see from this graph here as well is that there is hand in hand with this rapid increase in investment, there are AI imports, there are trade dynamics associated with it. Now, what is interesting about the AI sector for me is the question of how much of this is feeding a bubble or not. And what we know, or what we've learned about AI, is that these sectors have high capital intensity, so they require a lot of capital investments, and they have short replacement cycles. You have to replace the chips that you put in data centers within 3 years. And why do this matter to economists? They matter because we have to ask questions about revenue sustainability, right? That the idea is, if you pour so much money in capital investment, the idea is that somehow you will be able to monetize these investments and generate cash flow, and you'll have demand that will justify this spending. And for the moment, and when people say, "Oh, don't worry about the AI investment boom, it may be a bubble, but it will not generate some gigantic financial crisis," because a lot of this spending that is projected to reach almost 3 trillion by 2028. This is from Morgan Stanley, and projections here are a bit of guesswork. It could be 3 trillion. I've seen 10 trillion. I decided to go with this somewhat more modest sum. A lot of this projected investment comes from the retained earnings of the hyperscalers. So, the large big tech firms, they are not borrowing so much in order to invest in AI, but they are using their own funds, although that is rapidly changing. There was a paper from the Bank for International Settlements 2 or 3 days ago that showed a shift from retained earnings or from own cash flow. There is a shift now into borrowing from private credit markets, and that's typically private equity funds, other kinds of capital like sovereign wealth funds or venture capital, and increasingly traditional bond market issuance. So new AI, Silicon Valley companies who are issuing bonds in capital markets, and some securitization. This matters for the story on shadow banking. That is, data center loans are packaged, and then the securities, debt securities are issued on top of it. So we see a significant increase in, or a projected increase in spending. Now, why does this matter? It matters because I made the argument that there is overcapacity in US AI, and there is a soft budget constraint, and this takes me back to János Kornai, a Hungarian economist during the Cold War period that we now should be remembering a lot more carefully. János Kornai used to argue that state-owned companies in the formerly planned economies, or at that time in communist economies, these state-owned companies were inherently, white elephants, inefficient companies, because there were no markets, and the price didn't act as a signal that discipline the company into increasing productivity and efficiency, right? So you operate with a soft budget constraint. It means there you don't get signals from the market as to are you producing the kinds of products that are competitive, that you can sell better than your competitors in the market? In other words, you're not subjected to market discipline. And one could argue that most of the the AI companies in the US are operating with a soft budget constraint, in the sense that they are undertaking gigantic investments and gigantic spending that is not matched by an increase in the demand for the products that they are generating. And there are estimates from various management consultancies. Again, we have to take them with some pinch of salt. That they would have to, that the global demand for AI products that would have to generate revenue of around $2 trillion by 2030 to match the pace of investment spending by AI companies. And I think that's a very significant target and probably very hard to achieve, given reports that most corporations are not seeing the kinds of productivity improvements from AI that would justify large subscriptions or significant scale up in demand. So if this is the case, if they can generate this 2 trillion that is necessary to basically cover the costs of investment, what we can see on the horizon is an AI Minsky moment. And this comes from Hyman Minsky's theory of the financial instability hypothesis that you may or may not have come across already. But Hyman Minsky argued, firms, as we go through the upswing of a financial cycle, firms who are going through a period of exuberant optimism, they will take more and more debt on until their cash flow cannot cover interest and principal payments on the debt that they have raised. He called this Ponzi finance, and you can think of the possibility that there will be a Ponzi AI finance moment, and then you have a collapse in asset prices and debt related to the AI sector. And I just wanted to show you here in this graph something that we don't see very often, which is that the European financial system is deep, and the European economy in general is significantly exposed to both the US stock market and to the AI related stocks. Here you have open-ended equity funds from the euro area, and you will see that they are holding the share of US stocks that they are holding is significantly higher than the share of European stocks, around 2.8 trillion in US stocks by 2020, by the second quarter of 2025. 2.8 trillion is a significant number, and if though some of those stocks have a large price shock, then that price shock will matter for the European financial system as well. And in the report, I argue that one could think about the contagion to Europe from an AI Minsky moment traveling through the dollar funding exposures of European banks and European investors. And there are estimates. This is a story that we know from the 2008 financial crisis, when the crisis of shadow banking moved to Europe through this dollar funding exposures of European banks and through their exposure to the shadow banking system more broadly. Now, in theory, this should have been solved after 2008 because the US Federal Reserve introduced something called swaps. So the ECB has, in theory, access to swap lines. It could get emergency dollars from the Fed. Of course, now everything hinges on Donald Trump allowing the US Federal Reserve to provide these dollars. And it's a very open question now, even more so since the events of the last week, whether the Trump administration would not say you can get dollars, but you have to give me, I don't know, a piece of the Greenland is not the right analogy or metaphor here, because Denmark is not in the Eurozone, but the US administration can weaponize US dollar swap lines, and then the ECB and the European financial system is in significant trouble. The other source of contagion is if there is significant financial stress in the US that is not addressed immediately and that travels to Europe, like we have seen in 2008, then government bond markets, which are systemic collateral markets, a lot of the European financial system is built on government collateral. If there is price volatility in that collateral, we get margin calls, we get financial stress, and we can get a crisis. And again, here there is a question of the extent to which the European Central Bank will be willing to act immediately. It has, since the COVID pandemic, it has the transmission protection instrument. For those of you who remember those exciting times, Christine Lagarde at some point said, we are not here to close spreads. By spreads, she meant we are not here to make sure that everybody in the Eurozone borrows closely to the yields that Germany was paying at the time. She had to reverse that statement very, very quickly. Of course, now there are certain conditionalities that the ECB has in theory for interventions in government bond markets through the transmission protection instrument. We also know that there will be a new ECB president very soon. Whether that's a president that is willing to act swiftly or not is an open question. And I just wanted to show you as an example here that the European Central Bank, if it was a more ambitious institution and it operated in a different political economy, could adopt, for example, the US Bank Term Funding Program, the BTFP, that the Federal Reserve introduced in 2023 during the crisis of Silicon Valley Bank. And this particular program gives lender of last resort liquidity without doing market valuation of government bond collateral. And by eliminating this market valuation, it basically deals away with the destabilizing shadow forces in government bond markets. Again, that at the height of the government bond crisis in the Eurozone, Trichet and the ECB were not willing or not able to deal with. So that's this is the first bit, right? To say the first of the 3 points. We could be looking at an AI Minsky moment. If it comes, the Europe will not emerge unscathed. The extent of the damage will be determined very much by a combination of the political negotiations between Trump-dominated Federal Reserve and the European Union on dollar swap lines, and the domestic political dynamics around ECB interventions in government bond markets. The second point is a sort of more structural rather than immediate finance point, is to say what are the sort of short, medium term challenges that Europe has with respect to industrial policy. If you haven't decided, or I don't know what the timeline you have ahead, but you haven't decided what to write your dissertation on, this is to me a fascinating topic, the return of industrial policy in the global north as an instrument of economic statecraft. I would argue that this return has been accelerated, energized, unleashed, in however you want to call it, by China's Made in China 2025 industrial policy strategy. It is a misnomer in a sense. Although it's called Made in China 2025, the ambition was created in China. China wanted to move from being, the sweatshop of the world, the low skilled, low manufacturing base of the world, towards being a global tech powerhouse. Within 10 years, from 2015 until 2025, I think that this has been a decade of stunning achievement and progress towards that ambition. It is stunning in many different ways. Of course, there are things to consider around the macrofinancial bubble aspects of that, but in terms of the ambitions that China has set up, it's moving there very quickly. And it has done so by taking a sophisticated toolkit of industrial policy measures that combine both a lot of carrots, that is a lot of subsidies, fiscal, regulatory, financial, credit subsidies. It has combined all these subsidies with sticks, that is, with performance targets or strategies in order to make sure that the recipients of these subsidies do not deviate, or those subsidies do not use them for other purposes, but they use them in order to achieve the strategic priorities of the Chinese state. And there are examples in the EV production. I don't have a lot of time to go through that. I'm very happy to discuss it. It's been to me quite an impressive success. You have seen it, maybe if you read the Financial Times, you have seen it over the past year. You see all these graphs with China's dominance in various sectors of clean tech. I think you can see it also in robotics and AI, industrial AI use, not so much in, like a consumer AI. It has been characterized by intense competition and a very deliberate strategy to create globally competitive national champions. This is a strategy that picks national winners. It pushes them until they become global. It subsidizes them heavily, but it's also prepared to allow them to fail if they do not manage to remain competitive. And because of the Chinese turn towards this aggressive industrial strategy, and I mean aggressive in the sense of recognizing that most countries who have reached or who have very rapidly gone up global value chains, who have increased the technology intensive nature of their manufacturing and exports, they have all engaged in this aggressive industrial strategy. Since China did that in 2015, it created a global momentum that, and very importantly, not just a global momentum towards more industrial policy, but it created a very clear, for many in the US, in the national security apparatus, it created a very clear challenge to US economic hegemony. As in, it is a strategy that is designed to create companies that can compete against American technology-intensive corporations and eventually take them over. You can think Tesla and BID. There are many other examples. And it has pushed the United States during the Biden administration to explicitly embrace industrial strategy and industrial policy under the Inflation Reduction Act. And what is remarkable about the US turn to industrial policy is that they've chosen a carrots-only approach. That is, because of the political constraints of passing the IRA through Congress, the Biden administration has basically created a stack of tax credits that companies could access in order to, invest in clean energy or in batteries and all sorts of other sectors that the Biden administration deemed strategic. This is, in some ways, there were several problems, several critiques with this, and I've written a paper with Benjamin Brown on green macrofinancial regimes, and you can read a longer critique about this de-risking approach, about making manufacturing or clean tech investable for private capital. There are various critiques that one can make. Essentially, it puts private capital in the driving seat of industrial transformation. And private capital has not just one, set of constraints or signals that it operates with. It has several others. So, for example, if interest rates increase, then, the risk-adjusted returns might change away from the signals sent by the industrial policy strategy. Because of this lack of of a carrot and stick framework, because of the lack of state capacity to discipline private capital, I argue in the paper that even at its most impressive, the Inflation Reduction Act never matched the pace of industrial transformation that China could do with Made in China 2025. And then, of course, that also was, or that dynamic, that falling behind was also, in a sense, compounded by political cycles. As Donald Trump came to power, then the clean tech industrial push was abandoned, and the US administration has now moved into aggressively promoting AI. The America AI Action Plan, as they term it, it has three pillars. It says we will push innovation through regulatory de-risking, and this is everywhere. The US is also president of the G20, just assumed the presidency, and one of their main pillars is the regulatory de-risking. We are looking at a massive deregulatory wave across the world. Then an aggressive promotion of AI infrastructure that tries to accelerate both the data centers, the build-up of semiconductor manufacturing facilities and energy infrastructure, mostly, but not exclusively, fossil infrastructure. To my great sort of sorrow, having studied the turn towards green capitalism only 3 years ago, we live in a very different and much scarier world now. And there is a third element to this, and I think this is important as well, which is that the US is very explicit that it will push AI as ecosystems to allies and partners, in a sense, kind of forcing them to purchase AI-related or AI-produced goods. For example, the United Kingdom is integrating some Microsoft AI into its public service provision. The EU has committed to spend around $40 billion on US-made chips as part of the trade agreement. So the US under the Trump administration is willing to leverage this kind of, we can call it imperialistic, since they call it, they declare themselves an empire on TV. It's a sort of imperialistic statecraft that basically says, you want to be in our sphere of influence, you want to be our friend, you have to buy our products very quickly. There are some possible, sort of drawbacks to this, or fault lines. The China policy of the US administration is pretty volatile, as in national security experts were very unhappy with the fact that the Trump administration allowed NVIDIA to sell chips to China despite their advice. It is possible that we will have an AI Minsky moment. If this is the case, the European Union should, in my mind, and could continue with its risk-first AI approach. It's the only large economic power in the world that has explicitly stated that we have to think about risks, not just, some overhyped productivity improvements from AI. And what the bigger question of if this is where we are now, that we have a soft budget constraint in the US AI, which is aggressively supported by the Trump administration as a strategy of industrial transformation or a strategy of economic hegemony. We have China with a soft budget constraint, both in clean tech and now in AI and robotics as part of the Made in China 2025 strategy. What do we do as Europe, caught between these two superpowers who have either, economic power, or they have the fiscal and monetary and credit tools to support the soft budget constraints in aggressive pursuit of international competitiveness and market share. And what I argue in the paper, and this is a sort of direct dialogue with some of the European politicians that have tried to work through this very difficult conundrum and very difficult juncture in the European project. And the story that we hear from Brussels and from Frankfurt is everything would be great if finally the Capital Markets Union would work as we expect, if we had a savings and investment union. the Draghi report on competitiveness, which was supposed to create momentum to get European politicians to basically acknowledge that we don't live in a neoliberal world anymore. The market will not save us. We can only save ourselves. Even the Draghi report says we need 800 billion. We have a 800 billion funding gap. If we don't solve it, we will not get the scaled up industrial transformation. And what I argue in the paper is that this is actually not true. We don't lack capital in Europe. We don't lack investable funds. Actually, if you compare, and this is from a paper by the European Central Bank researchers themselves, Europe has a higher relative share of financial assets to GDP than the United States. That is, in relative terms, our financial capacity, you could say, is bigger than the United States. Our problem is not that we don't have the money. Our problem is that we do not have the instruments and the political will to steer that money into strategic priorities. Our portfolio GLAD is directing, as I've shown you earlier, towards AI stocks in the United States, in part because there are not sufficient returns here, and in part because the European Union has adopted a kind of weaker version of the de-risking approach that the Biden administration had. And this is not an argument that I make alone. The European Commission uses the term de-risking not just to describe a delinking from China, but to describe its strategy to mobilize private capital into strategic areas. And I argue in the paper this will not be a successful strategy. If you're not able to discipline capital into your strategic priorities, not only that you will not get the kind of competitive model that can pair up with the US and China, but what we are seeing, and this is a bigger worry to me in some ways, is a rapid dismantlation, implosion, if you want, of the social contract that the Europeans have under the welfare state. I think this over the next 5 to 10 years, certainly before I become of pension age, we will see the social contract and our in now maybe historically unique collective welfare system. It will become much harder to sustain. And I can elaborate why this is the case, but this is a particular worry that I have, that we are going to become a lot more like the United States in the precarious individual saver sort of style of dealing with the future uncertainties, not in our ability to compete with China or other great powers. And finally, and I give I make several suggestions there of how to deal with this. Finally, the rise of stable coins. This is in many ways a relatively new area. It's been hyped a lot. I was very skeptical about stablecoins for a very long time because they just seemed to me that they were Facebook. If you remember Facebook Libra, they were a big tech US sort of story or narrative that was going to back or amplify the crypto speculation. I have changed my mind now a bit. I think stablecoins are more systemically interesting than I thought before. And just to clarify, what is a stablecoin? A stablecoin offer is it's a digital dollar or a digital euro or a digital whatever. You hold it in a wallet. It promises one-to-one convertibility between state-backed money, between a US dollar and a euro, and the stable coin you hold in that wallet. It can be, I will show you in a second, most of it is issued by US financial institutions like Tether or Circle. They promise moneyness, and this is, remember, we started the session with critical macrofinance cares about moneyness. They promise moneyness in the sense that in theory, you don't have to worry about holding all your savings in American stablecoin because you should be able to convert those stable coins into dollars or into euros whenever you want at 1 to 1. So at par on demand is the the jargon for this. However, we have now in Europe put ourselves in a very difficult position in relationship to stable coins because the MiCA regulation, the markets in crypto assets regulation of the European Commission, says something very bizarre for somebody who studies money like myself. It says, of course, these can be, we have to put rules. We need to have rules to make sure that these stable coins will be able to meet their promises to convert back into regular money. And these rules in Europe are that, you know, when you give your, let's say, let's do it for the sake of simplicity with dollars, because we have here the Circle issued USDC money. So if you and me and everybody else buys converts $100 into stable coin. The issuer of the stable coin now has to do something with his dollars. The clever thing that they've decided to do is not to hold them in bank deposits, you know, because you could hold them in bank deposits and say, when Daniela wants to convert back her stable coin into dollars, I just go to the bank, I take the dollars, give it to Daniela, destroy the stable coins that she had. No, they don't hold them in bank deposits because these don't generate as much return as other financial instruments. And what we see here, USDC, which is issued by Circle, the second largest stablecoin circulating in the world, it has a fund that is managed by BlackRock, and this fund is issuing USDC. These are the stablecoins in green on the left-hand side. Ignore for a second the euro-dollar bid. And then it gives the dollars that it received for stablecoins, it gives them to BlackRock. BlackRock has a reserve fund, and with those dollars, it buys US treasuries, or it lends those dollars through repo lending against US treasuries. And for Scott Bessent, for the US Treasury Secretary, this is a great idea. And the US is very enthusiastically aggressively promoting stable coins, because it says this will be a new source of demand for US government debt. A new source of demand for US government debt that will reinforce the international role of the dollar. We kick two birds with one stone, because it's very difficult to issue or to compete against dollar-issued stablecoins. Most of the countries in the global south that are turning to this are using dollar ones. So for Tether and for Circle, this is a great business model, because they take my dollars, they give me no interest, right? They just give me a stable coin, so I can use it for paying for, I don't know, things, crypto or digital assets that I can buy through my wallet. They don't have to pay me anything in interest, and they get 5% interest from buying US treasuries from lending to the American government. It's a very nice business model, because, you know, you get a fee of or a return of 5% without any funding costs. There are some I've heard some speculation that some of the smaller stablecoin issuers might start paying a bit of interest on stablecoins, but this hasn't happened so far. Now, why is this a problem for Europe? You could say, okay, this is a long story, may or may not be interesting if you are interested in theories of money. It's interesting and systemic in some ways for the European Union, because the European Commission has said that there is no difference between stable coins issued, dollar stable coins issued in the US, or the dollar stable coins issued in the European Union. If, in this case, Circle, I'm showing you here the example of Circle, the company that issues USDC, because Circle has a MiCAR, Markets in Crypto Assets Regulation, it has a MiCAR passport. It has met the conditions for this dollar stablecoin to be treated as a stablecoin in the European Union. It basically now enjoys a fungibility. The circle enjoys a fungibility for its dollar stablecoins in two legal jurisdictions with two different sets of rules for how you manage the reserves, how you back this moneyness, and how you are allowed to convert or not. So in the European Union, you have to the issuers of stablecoins have to keep 30% of reserves in bank deposits and 60% for significant issuers. That is, Circle has to keep 60% of reserves in bank deposits, which are lower yielding than if they invested them elsewhere, and the rest in low risk assets. Plus, in the European Union gives stablecoin owners, that will be me in this case, the users of stablecoins, it gives us instant convertibility rights. I'm allowed to convert back into the national currency, into dollars or euros, whatever the denomination is. I'm allowed to convert at any time. That is not the case in the US. In the US, only if you're an institutional client, or only if you're BlackRock, or an asset manager, or a private equity fund, or a bank, then you can convert instantly. Even then, you have to pay a small fee. Retail clients might be more vulnerable to depegging. So this has created, in some ways, a crazy system, because it kind of encourages regulatory arbitrage between the US and the European Union, where you are basically issuing and hoarding, you're issuing dollar stable coins in the US, and then you can convert them because you have a better rules in the European Union. And there was a big fight in the European Parliament trying to get the European Commission to revise this fungibility rule. The European Central Bank has moved the fight onto the terrain of the digital euro. It said, look, if we are to have stable coins, then why not a public as opposed to a private stable coin? Let's create a digital euro, make sure that if our citizens want to have wallets to purchase crypto or to purchase digital assets, they don't need to use a privately issued euro dollar stable coin that has some leg in the United States. They can use a public stablecoin issued by the European Central Bank. This fight is ongoing, so if you want to study it, you're welcome. It's probably one of the most fascinating fights that will happen this year in the European Parliament and the European Council around questions of monetary sovereignty. I have zero idea who will win this fight and on what terms, because things are changing so quickly that we may or may not see more appetite for monetary sovereignty or less appetite for monetary sovereignty. Right, so I'm going to stop here and maybe take questions. Just to remind you very quickly, I have 1 minute left from my 1 hour. To remind you, I said in this presentation, drawing on critical macrofinance, that there could be an AI Minsky moment on the horizon in the United States. It will travel to Europe if the investment bubble explodes. If it travels to Europe, the extent of the damage and the financial stability threats will depend on both the actions of the US Federal Reserve and the actions of the European Central Bank and the restraints on this. The European Union is falling behind on the industrial competition, the structural competition that is going on at the moment. It's falling behind not because we don't have the money, but because we don't have the state capacity to articulate an industrial strategy that will move us into that direction. And finally, we will not get a global euro. There are many different reasons why we will not get a global euro. The more realistic possibility is that we will get private stablecoins issued by American big tech firms or big finance firms who will erode more and more of the monetary sovereignty of the European Union. Okay, thank you. And I'll take questions.